1, 2, 1, 2, 3, 4. I said money's always moving, yeah. Money, 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 it's always on the go. Like a river from the mountains that flows down to the coast. Money, it's always on the go.
In this savings unit, we learned a little about interest rates. In this unit, we'll learn about a key factor influencing the interest rate you pay, the Federal Reserve. We've learned that the Federal Reserve is the U.S.'s central bank and that their job is to adjust the amount of money in the economy and to oversee the banking system. One aspect of this job involves setting economy-wide interest rates. First, we need to define a few terms. Then we'll see how the Fed can influence the interest rate on your mortgage or credit card. The federal funds rate is the interest rate that banks charge each other on short-term loans. You see, banks are legally required to have a certain amount of cash on hand. During the course of a day, deposits come in and loans get made. If a bank doesn't have enough cash on hand to meet the legal requirement, it can borrow money from another bank for the day. This is commonplace in the banking system and is absolutely nothing to worry about. Anyway, the federal funds rate is one of the lowest interest rates in the economy. The discount rate is another fundamental interest rate. It's only used in the worst-case scenario of a bank running out of money and needing to borrow directly from the Fed. Another fundamental interest rate is the prime rate. This rate will be the rate that banks give to their best, largest customers on loans. The prime rate is usually a percentage point or two above the federal funds rate. And here's where you come in. On many consumer loans, the interest rate you pay is based on the prime rate. You'll pay prime plus X, where X will be an interest rate comprised of your credit risk, the real rate of return the lender wants to earn, and an expected inflation rate. Some credit cards advertise a rate of prime plus 12. If the prime rate were 4%, then your credit card interest rate would be 16%. The Fed can influence the federal funds rate through buying and selling government bonds. This process is kind of complex, so we'll skip over the details. If you want to learn exactly how it works, please go to federalreserve.gov to learn more. Regardless, when the federal funds rate is raised, the prime rate goes up, and so do interest rates for consumers. When the federal funds rate is lowered, the prime rate and consumer interest rates also fall. So, if you're looking to take out a new loan on a car or home, you want to pay attention to what the Fed is doing at its meetings. The results of the meetings are always announced in the news. If the Fed announces it will be raising rates, then you want to take out your loan sooner to get a lower interest rate before they go up. If the Fed announces it will be lowering rates, then you might want to wait a bit before taking out your loan. The interest you pay on certain types of debt is tax deductible. If you have a mortgage and itemize your deductions, as opposed to taking the standard deduction, you can deduct the value of the interest paid from your gross income, thus lowering your taxable income. If you have student loans, you may be able to deduct the value of the interest you paid, provided your overall income is low enough. In 2013, if you are single and make less than $60,000, you can deduct the interest value up to $2,500. If you are married filing jointly, the threshold is $125,000. If you are married filing separately, you cannot take the deduction. If your income is between $60,000 and $70,000 and you are single, you'll be able to deduct a portion of your student loan interest, but not all of it. If you are married filing jointly, the threshold is $155,000. The student loan interest deduction does not require you to itemize. You can take the standard deduction and still take this deduction. These dollar values are adjusted for inflation each year. Check the IRS website each year to find the exact income requirements.